KVB PRIME, developed for global traders, growing together with you.
Good evening and welcome to this week's KVB Prime Weekly Market Commentary. This week's topic is Brexit and what changes did it bring to us. There is no doubt that Brexit is the most significant event since the establishment of the European Union, and Brexit brings both benefit and risk into UK. On one hand, it represents the success of democracy and the short-term relief on the economy. On the other hand, it mirrors the conflict amongst different social classes as well as the political party within the country. Broadly speaking, Brexit breaks the integration of the EU and further promotes the reform of UK and EU members. Now, let's look at timeline recap. On 24th of June 2016, a public vote was held in UK with 52% up for Brexit. After announcing the result, pound fell steadily in prices with 1,800 basis points dropped, and the daily maximum decline was up to 9.25%, whereas the weekly maximum was 13.5%. It is predicted that UK will be facing economic and political disaster for the next 2 years. In June 2016, the former British Prime Minister David Cameron quitted his cabinet role and Theresa May took the role 3 weeks after. On 7 October 2016, President of France warned that Britain must pay its price for Brexit. The tough attitude led to another significant drop on the pound, which declined more than 6% on the day, and the weekly fall was up to 9.72%. On 17 January 2017, Theresa May gave a speech and clarified the 12 prior objectives for Brexit negotiations. Later, British pounds soared against USD rapidly and broke the previous resistance level from October last year, which rose to a record height of 1.2381 since 6 of January recording, the largest daily jump since 6 of December 2016. In June 2017, EU and UK began their first round of negotiations. In the same year, on 12 December, the European Union Withdrawal Agreement Act passed by the House of Commons, and as a result, pound appreciated to 1.3289. On 8 December 2017, Brexit reached its first stage of success as other 27 country members agreed to it. At the same time, it announced the entering of Stage 2 negotiations. The British pound rose more than 7% over the next 6 weeks after these announcements. On 19 March 2018, European Union and UK reached an agreement regarding to the transition period of the next 2 years. Later, the pound went up to a stronger position and reached another record high of 1.4376 in 22 months. However, as the negotiation came to a deadlock, the pound has fallen 9.78% in the following 2 months. Finally, the European Union Withdrawal Agreement Act officially became the law on 26 June the same year. The original deadline of Brexit was on 31st March 2019. However, a timeline extended since UK Prime Minister had a prior extension twice with EU's agreements. On the occasion of 3 years public vote in July, Boris Johnson became the second Prime Minister after Brexit began. He promised that UK will exit from EU on 31st October regardless of the withdrawal agreement. Over the following 3 months, the UK has passed a ban on no-deal Brexit. Later, Johnson proposed a new plan and revised the EU exit date. The withdrawal agreement bill, proposed by Prime Minister Johnson, had passed the UK Parliament on 22nd of January 2020. On 29th, the EU held a meeting on discussing this bill. Finally, the 3-year-long Brexit came to an end. The UK officially withdrew from the EU on 31st of January. But this is not the end of the story, as UK entered into an 11-month transition period from 1st of February. There is no doubt that Brexit is a big lesson to the UK and will sacrifice the country tons afterwards. Now let's look at what the pros and cons of Brexit. First, let's start with cons. Firstly, the flows of commodity between UK and EU will not be as smooth after Brexit. In particular, the food and textile industry will be hit the most. Analysts predict that the market prices of clothing can increase by 12% after imposing the tax to UK's exported clothing. Further, the dairy product in UK are facing a tax rate range of 55% to 200% when exporting to EU member countries. The taxation, or tariff, may burden the foreign firms on their operation costs and accelerate the outflow of foreign investments. Second, the investment reduce. Multinational firms are likely to reconsider the size of investment in UK, which can pose a threat on London's key financial position. Previously, the reason why UK was a preferred location of multinational business investment was beyond the strong national economy and the population size of 65 million, it was also because of the huge potential market with 500 million population in the EU members. This competitive advantage will disappear after Brexit. Also, UK's export will be suffering since 28% of the commodities are exporting and half of them is to EU. Such large proportion of export was benefited from the tax-free relationship among EU members. However, UK's competitiveness dropped dramatically since the tax is now adding heavily on the UK's exported products. This can further reduce the national employment and people's welfare. Lastly, the negative impacts can extend to educational industry. UK has a world-leading education system with plenty of world top universities, such as Oxford and Cambridge, just to name a few. But this position can change after Brexit. The reasons are, number one, these educational industries were no longer sponsored by EU for researching and inviting leading researchers to the UK. Number two, local students and researchers are no longer being sponsored to other EU countries for exchange and further studies. Then, why is the UK clinging on to Brexit? The consequences of Brexit also brings benefit to UK. First, there is a huge save from the EU membership fees. Second, UK will no longer need to obey refugees and asylum policies from the EU. The society was unhappy with the increase in crime rate and decrease in job opportunities due to the large waves of immigration into UK. Hence, the public are actually looking forward to the Brexit. The most important advantage is economic freedom. Being the member in such integrity community, the UK was not able to develop a close economic relationship with non-member countries. After Brexit, the UK has its own autonomy to negotiate with any countries in order to generate the maximum profit for the country. In addition, the Commonwealth countries is a unique resource owned by the UK. After Brexit, there will be more opportunities for trade growth between these countries. Without high production standards and strict regulation systems from the EU, the UK can now reduce production costs to boost its employment and help grow small medium businesses. In the long run, Brexit aids the UK to become a more independent and resilient economy. In regarding to the international relationship, the UK was one of the most powerful countries within the EU and contributed to the decision-making significantly. However, the power and international influence can be reduced after Brexit. As Brexit is the first event in history, this can potentially become a bad precedent for other EU member countries. Now, let's look at major asset weekly analysis. First, let's start with British pound. British pound before the Brexit event experiences large fluctuations. First, on 13th of December 2019, when Boris Johnson won the election, it signaled the countdown for Brexit. On the day, pound surged 300 basis points, recording the highest since May 2018. After digesting such information, pound then experiences a dramatic fall. On 31st of January 2020, Brexit finally was announced. Pound again surged on the day. However, 1.32 became a key resistance in preventing pound surging higher. The uncertainty in commercial negotiations resulted in pound floating between 1.32 and 1.272. From 10th of March, due to the outbreak of COVID-19 and the misconception of mass immunity creating market fear, pound experienced 10 consecutive falls, recording the lowest since 2000. Finally, on 24th of March, the rebound of USDX and UK ditching the idea of mass immunity reduced market fear. Thus, pound began a new round of rebound. For the past 2 weeks, pound reached a new high of 1.25 and fluctuated between 1.25 and 1.215. The interest for this week is the strength of the resistance 1.25. Once the market break open 1.25, it will further challenge the new resistance 1.272, extending the rebound on a daily basis. On the same token, if the market falls below the support 1.215, opportunities for short will be widened as the market will have new rounds of adjusting downfall. Now let's look at US dollar. US dollar last week experienced large fluctuations. The overall market trend is just as predicted. On Monday and Tuesday, we talked about how the market would challenge the resistance 101. However, we predicted that the strength of this resistance is strong enough to prevent market advancements. Thus, we saw the adjusting downfall on Wednesday. The market had no further intention to challenge the resistance once again, hence falling back to 100. For this week, our intention will be the market response between upper resistance 101 and the lower support 98.3. The increasing strength of the US dollar is clear. As long as the market doesn't fall below the key support 98.3, the overall uptrend of the market will not change. The narrowing price boundary is our key focus for this week. Traders can enter the market by following responses in between. Now let's look at Euro-Dollar. Similarly, Euro-Dollar last week rebounded while experiencing large fluctuations. The fluctuation trend between 1.1150 and 1.0630 will continue this week. Similar to USD, the price boundaries are narrowing. Thus, the support 1.0760 will help us to determine if Euro are strong enough. Overall, Euro are maintaining the downtrend over the past 2 years. Every time the market breaks open, the support is an opportunity to short. As long as the market doesn't break open the resistance 1.1150, opportunities of large scale are not mature enough. Hence, short on high price points will be more appropriate for traders. Now let's look at gold. Gold prices climbed steadily last week. The trend is clear. The high point 1703 is an interesting resistance. Once this position is taken down by loan, the next target will become 1755. Otherwise, the lower support 1567 is strong support. As long as the market doesn't fall below this price, it is only a matter of time for gold prices to refresh its record high. Lastly, let's look at crude oil. Under the influence of strong USDX, the decrease in demand of commodity due to COVID-19 and the price war between OPEC members and non-members, it resulted in oil prices plunging to the lowest in 20 years. Currently speaking, WTI prices are under $32 with no potential for a large rebound. Under the price of 32, the first support is 25.3, followed by 20.6. If during the week the market falls below 20.6, the market will open up more opportunities for a downfall. Last week, oil prices continued to fall. Percentage fluctuations on a daily basis increases. Traders should note that portfolios with high percentage hold of crude oil can be considered as high risk. That's all for this week's KVB Prime Weekly Market Commentary. Thank you for listening. I'll see you next time.